Sandeep Batra, the Executive Director at ICICI Prudential Life Insurance, to join in and chat about what's the way forward for ICICI Pru from here. Sandeep, hi, morning. Your company is truly one of the companies that has, been a rise with India story. Walk us through how has the entire landscape changed, according to you, in the recent past in the insurance industry, and especially in light of demonetization and the entire digitization in the insurance sector.
Thank you. First of all, thank you for having us on the show, and I want to compliment ET now for introducing this tagline called Rise with India. I think it's most apt given the significant structural reforms which have happened in this country over the last 3-4 years, and it is in this context that I'll talk about life insurance. If you'll see from a reforms perspective, there has been GST, there has been RERA, there has been Uday, and you have had a host of these reforms, and based on these reforms, we can see over a longer period of time India's GDP to continue to grow. I mean, it's estimated to grow at about over 7% over a longer term periods. Of course, there have been short-term blips, which is sort of okay. The second aspect of these reforms is a significant financialization of savings, and whether it is demonetization or GST or even the restrictions which came as part of this budget, putting caps on what you can spend as cash. You will find that the financial savings are going to grow at a much faster pace than what they have been growing in the past. If you see the last 5 years data, financial savings as a percentage of GDP is now about close to 8%, growing at anywhere between 14 to 15% CAGR. Clearly, we have been one of the bigger beneficiaries of this, along with the rest of the financial services industry, which includes banks and mutual funds. Putting this in context, you'll see coming to the life insurance numbers, you'll see in FY16, the industry grew at about 8%. In FY17, it grew at over about 22%, and a fair bit of increase actually happened in the second half. Whatever we may talk about, demonetization, one statistics really stands out of is actually the currency in circulation. The currency in circulation even today, when we almost 1 year post demonetization, is less by about 3.5 trillion rupees on an aggregate basis, which is 20% less. And of course, during this period, the economy itself has grown. So that money has come into the financial system. We do believe that will help structurally over a long-term basis. To answer your questions on long-term prospects of the insurance industry, this industry has been growing largely in line with nominal GDP, but we do expect the pace to accelerate given whatever else has happened on the reforms and financialization of savings.
Okay, now in the recent quarters, we've seen a strong pace of gross premium growth and new business premium, although on a relatively lower base. So how sustainable are the current double-digit growth rate for ICICI Prudential Life?
The gross premium that you have seen growing is from a smaller base, as you rightly pointed out. The base actually increased post demonetization, so clearly we will see some moderation of growth. Structurally, as I mentioned, the industry is expected to grow a little ahead of the nominal GDP in this country, so it's 11 to 15 odd percent. But let's see how the pace of financialization actually takes up. I'm pretty bullish on the growth prospects, and increased financialization of savings should help everybody operating in the financial services sector, including the life insurance industry as well as us.
Right. Your market share has improved from 11% last year to about 15% in the recent Q1 on the RWRP basis. Factors that will lead to further market share, according to you, in the next, say, 3 to 4 years?
As a company, we are going to be focused on the consumer, and market share is actually a consequence of what we do. From a consumer perspective, there are two areas that we operate in. One is the long-term savings, other is the protection. In long-term savings, our basic focus is on trying to sell consumer-centric products and let the customer choose the kind of products that he really wants. Protection is a nascent part of our business, a lot more smaller, but probably from a customer point of view, the biggest need, and we see that growing at a much faster pace. We really don't have a market share target. We really want to focus on products which are going to be customer centric, and as long as we are able to meet the customer needs, it will show up in our market share.
Now, post SBI Life, we have 3 players and valuation is ranging between 3.2 time to about 4.5 time price on embedded value. What is your view on valuations? Is there scope for further multiple expansions?
I think you have to see the industry in the context where we are. We are seeing we are in a country which is clearly growing at a at a rapid pace of over 7%. There is a lot of under penetration in insurance, especially measured as sum assured to GDP kind of a ratio. There is more financialization of savings which is happening. So the growth potential of the industry is really large. So as a company, we are really focused on expanding our value of new business, which comes from both expanding our savings business as well as protection business. What is going to be the valuation is actually going to be determined by the investors. But as a company, we are going to be focused on expanding the value of new business, which comes from both the protection side as well as on the savings side, and on the savings side more particular about ensuring that the products are customer centric and we fulfill the long term needs of customers.
Right. Sandeep, so coming to your product mix then, how do you see the mix shaping up between ULIPs and par and non-par? What do you think would be the key changes that you're going to make to your product mix and hence the scope for further margin expansion?
Okay, let me answer this in 2 parts. One is on the savings side and second is on the protection side. If you see on the savings side, there are broadly 3 categories of products: unit linked, participating and non-par. As far as we are concerned, we let the customer choose what kind of a product he wants depending on his risk appetite and cost structures and benefits which are associated with the product. We do not really drive a product mix within the savings category. Unit linked at this point of time is clearly a dominant portion in our case, given the attractiveness of the product from a consumer angle. It has lot lower charges as well as it gives a choice of asset class to the consumer. The second part is on protection, which is clearly a much smaller portion of our business but growing at a much faster rate. Over a longer term basis, we do expect, given the extent of under penetration on the protection side in this country, the protection business would grow at probably at a faster rate than the savings side, and that's where you will see some of the mix changes. Within the savings category, as a company, we are quite agnostic to what the product the consumer buys. We are not really pushing for a particular product mix.
Right, Sandeep, you've also had a strong distribution network with a strong bancassurance partner as well. How do you see your distribution further deepen in the next few years, and how do you see that translating into lower costs then?
Let me put this question again from a consumer angle. I think we let the consumer choose the product. Similarly, we let him choose the channel as well. We have got 4 channels and we are very well invested in all of them. One, of course, is the bank assurance that you talked about. There is an agency channel which is growing very well. There is a direct channel which consists of our own proprietary sales force as well as on our website or on web aggregators. And then there are corporate agents and brokers. We would let the customer choose the channel, and if you see the mix in channel is a result of the customer choice and strategies driven based on a more local need in terms of how we have organized a business across geographies. We really do not drive a particular channel mix as such. So each of the channels is profitable, each of them is growing, and as long as the consumer is satisfied, we are happy to let the mix evolve over a period of time. For us, persistency becomes a very important parameter from a consumer angle because that's a reflection of the quality of sales that has happened. It also helps us improving our margins from a consumer as a company. Yes, costs, we are clearly one of the best ratios that we have in the industry. We will continue to work on improving our cost ratios to meet the needs of both our shareholders as well as our customers.
Right. So taking a little longer view, say about 3 years, your solvency ratio is over 2 times. We do understand that there is a need for capital as of now. Would there be need for capital raising then further? And is there a case for ICICI Bank further selling stake in order to raise money?
I think stake sale is a question which let the shareholders answer. As an operating company, in terms of as an operating company, we are sitting very comfortable with the capital. We have about 280% solvency ratio against the regulatory requirement of 150%. So even if we continue to grow at the pace that we have been growing in the last few years, I do not anticipate a further increase in capital. We also have other levers in terms of dividend payouts. We are actually declaring dividends much higher than the stated dividend policy given our comfortable positions. Secondly, there is also options of raising tier 2 capital, which IRDA now allows. So before we really come to the market, we will evaluate all the parameters. But the short answer to your question is, in the near term, we do not see the need to come to the capital markets to raise more capital for the company.
But if we look at your industry, there are not 1, 2, 3, 4, there are 23 players and very few players have strong market share. There's also market share shift from public sector to private players. What are your thoughts on consolidation here?
Okay, let me put some numbers in context. Today there are about 23 odd players on the life insurance side. When LIC was nationalized in the 1950s, there were 250 life insurance players. Okay, so while you can say 20 is a crowd, but I mean, you'll have to see more in a longer term context. Secondly, I mean, life insurance business serves two needs. One is on the protection side, another is on the savings. The protection is a more nascent industry. It allows space for more innovation, and and it can grow at a much faster pace. The savings business is more about scale. So as long as these players are able to achieve scale, I mean, they should be fine. Otherwise, I think the market forces will play out at an appropriate point of time.
Okay, Sandeep, we're going to thank you on that note. Thanks so much. Completely running out of time, sir, to end the interview here. Good to chat with you as always.